Hi, welcome to another edition of Mortgage Clarity. In this video, we're going to talk about home affordability. What does it mean? How you define it? And are homes more or less affordable today than they were 15 years ago? And I think this is a great time to do a video like this because with home prices going up and interest rates going up, we're hearing a lot of talk about home affordability. So it's important for us to understand what that means. So we're going to go through a few things, but very first, I want to start out with kind of a definition of what does it mean to be home affordable. And this is for the industry. Now, affordability really comes down to the individual. There's a lot that goes into it. But as a rule of thumb, when we talk about are homes affordable and not affordable, we're talking about when you take a look at the principal and interest payment on the mortgage you're going to get, as a representation, as a percentage of your monthly gross income, is it 30% or less? So if you've got 30% or less, then the home affordability equation is intact. But as you start to take more than 30% of your monthly income in order to afford housing, housing's not affordable. Whether it's owning a home or renting a home, when you're starting to take more than 30% of your income, it may not be so affordable. And again, this is just a general rule because a person who makes $4,000 a month using 30% of their income compared to a person that makes $10,000 a month using 30% of their income, the person making $10,000 has a lot more disposable income to account for things like food, gas, and all the minimum requirements that we have. So again, we're talking generalities. But let's take a look here and see where the market's gone and how this impacts affordability and whether or not, in fact, homes are more or less affordable today than 15 years ago. Okay, so here we have the CaseShiller Index. And the CaseShiller Index is kind of the gold standard for trying to track and measure home appreciation year over year. And this one just goes up through May of 2021. And you can see that all through 21, the rate of home appreciation has accelerated. And actually, by the end of 2021, we saw year over year home appreciation hit over 20%, with some states seeing as high as 35% year over year. So normal appreciation is 3 to 5%. So it's safe to say that we definitely have gone through much higher than normal home appreciation, which is great if you own a home. But if you're trying to buy a home in this market, it's a bit intimidating and does beg the question on whether or not homes are affordable. So let's go ahead and go on to the next chart here and take a look at interest rates. So here you can see that from 2016 up to today, home values are up about 53%. However, during that same time, rates have gone from 6.75% to the beginning of 2022 to about 3.75. Now, these are just average rates. We're not quoting rates here. Down payments, credit scores, property types, occupancy, all these things play into factors. So we're just looking at averages here to track this. And so you have to look at rate alongside that home price because home price in and of itself doesn't determine the actual monthly payment. So as you know, with rates going down, that reduces the monthly payment. So it's a question of how much did rates go down in comparison to how much did values go up. So let's take a look at this chart here. So affordability. So the 100 line here, this black line on the 100, we call that that's the baseline to where homes are affordable. If you're hitting right at that, you're at the mark. As you fall below it, like we were here through this time here and over here in the 90s, then you're considered stretching that affordability. You're starting to take more on average of your monthly income to qualify for that payment. Whereas when you go above that, you're actually reducing that and you're in a more affordable category. So that's kind of what this represents. And this goes through 2020, doesn't show the 2021, not 2022. There's definitely been a change because as you just saw in that last chart, the rate of home appreciation and interest rates have changed in 2022 or 21 versus 2020. But we're going to look at those as an actual number scenario. But this chart, I think, does help you kind of understand that for quite some time, with home values going up, for last, since 2013 or so, been very strong growth, it still has remained affordable. So during the same time when we had those home values going up, we've seen income go up. And this is really the relationship that we have to look at. We got to look at that monthly payment as it relates to monthly income. So we can't just simply ignore this, because what you'll see when you actually dig deeper is during this same time while home values were up 53%, income rose 63%, as you can see through here. So from an average hourly earning back in 2006 of $20 per hour up to about $31.63. So that's a significant growth of income. So let's take a look at this and do a sample. The reason you gotta look at income is because typically a 1% rise in your monthly income can support about a 5% rise in your monthly housing payment or rent payment. So why is that? Well, it's because when you look at the 1% rise on your monthly income, that's on your whole income, but you're just using a percentage of that to actually make your monthly payment on the housing part. So if we go here with a $1,000 monthly payment with a household income of $5,000, but because of either home values or interest rates or a combination of both, let's just say that the payment rose 5% year over year. But during that same time, income went up 1% year over year. When you actually look at the numbers, you'll see that you're actually in the same boat here. You're still netting out the same as you are here, even though the payment's higher. So that's why it's really important when we start to have a conversation on affordability that we don't just look at any one of these things. It would be wrong to just look at income and say income went up so it's more affordable if it didn't go up, or went disproportionately to values or rates. So all three of these things must be considered. So let's dive into the last chart here. And the last chart what we're going to do is we're actually going to take a look at kind of a scenario. Now this is just a hypothetical here. We're going to use a rate of 6%. We're not quoting interest rates here. And again, for simplicity's sake, we're going to say that the purchase price of $300,000 is the same as the loan amount. So 100% financing with an effective rate of 6%. And we're going to see how this looks as a payment compared to income. So 2006, $300,000, interest rate of 6%. Had a monthly payment of $1,800 per month. When you look at that, that's just your principal and interest. There are taxes and homeowners insurance that would get added to this, but we're just focusing on the mortgage. And the household income was $6,000. So that means the monthly payment represented 30% of the household income, which puts it right at that baseline. It's still affordable, but you're not, it's not super affordable, and it's not quite unaffordable for this particular borrower. But let's fast forward now in 2022 and say we have the same borrower, same situation. We're just going to apply to that the average rate of appreciation in both income and home values, and then look at this and see if we're better or worse. So if we take 53%, add that to the 300,000, we have a new value of 459,000. Using kind of an average rate today of say 3.75%, that would come to a principal and interest payment of about $21.25. Now, again, we're going to add the same average rate of appreciation to the income that we saw that's happened, and that means the income is now $9,780. So when we do our math and we look at what this represents as a percentage of the income, we'll see it's actually dropped. It's 21.72%. So even though we see higher home values, particularly higher home values this last year, and rising interest rates, currently the state of the market is that homes are more affordable than they were 15 years ago. So again, I think this is really important for those of you who are out actively looking for homes, because it can get a bit discouraging as you're looking for a home. It's very difficult to get offers accepted with so many people looking for so few homes in the market. But even though values are going up, rates are going up, the numbers are still in check that the homes are affordable. Again, you have to know your own budget. And if this trend continues with rising income, as long as the income and the home rates and the monthly payment are in line, you're great, but that starts to condense, then they could become unaffordable. So something for us to watch, but in the short term, homes are affordable by that definition we started with. So to find out more information about mortgages and everything related to that, check out other YouTube videos. If you like this video, please do a thumbs up, share it, add your comments if you got questions. Look for future home videos where we start to dig into the benefits of home ownership versus renting. Particularly now we've talked about affordability. Assuming a home is affordable for you, doesn't make sense to buy a home if your monthly payment's $2,000 a month on the mortgage if you could rent for $1,500 a month. Which one should you do? Well, stay tuned, look for that video, and we'll go into detail. Until next time, have a great day.